All right, welcome back, traders. John Caruso here for the evening of June 14th. We're going to do a quick recap of the FOMC meeting this afternoon. And of course, we're going to take a look at a couple of the charts. So the Fed put on today what the media is describing as a hawkish pause or skip or whatever you want to call it. They did hold the Fed funds rate steady at the target rate 5 to 5.25%. However, their forecasts or their dot plot, if you will, is now forecasting 2 additional interest rate hikes this year. I believe July and September are going to be viewed as live meetings right now. And the median forecast is naturally raised to 5.6% by the end of 2023. So it appears as if the Fed is not done. We're going to see about that. We do know that on the announcement, we did see the U.S. dollar strengthen. We did see yields rise a little bit. We've actually seen yields bounce over the last couple of days. Right now, back to about 380 on the 10-year yield. The dollar did strengthen up on the idea of more interest rate hikes. We're going to wait and see. We're going to see what happens. I'm not completely sold that the Fed is going to be raising anymore, but right now we've got to take them at their word, and they're placing 2 more quarter point interest rate hikes on the table. We did listen to Jeff Gundlach this afternoon. He came on TV. He thinks that they are done. I'm not so sure. I know Jeff just 3 months ago was talking about the Fed having to raise to 6%, the Fed funds rate to 6%. So he was wrong on that. We're going to see if he's wrong or maybe he's right on this. We'll have to just remain data dependent from here. We do think, and we do see evidence that the growth data is only going to slow precipitously from here. We do think the jobs data from here are likely to soften, and we're likely to see the unemployment rate begin to increase from here until the end of the year. So from the growth side of things, from the idea that the consumer is likely slowing. We're going to see the retail sales numbers come out tomorrow as well. So that's going to be very interesting to see. But we do project that the consumer is slowing. We do project that growth is only going to slow precipitously from here. We do still believe that inflation is still going to continue to slow right now, albeit we did see a sticky core CPI number on Tuesday of 5.3%. So, with all that in mind, I'm just playing the wait and see game as far as the Fed. I'm sure we're going to have a whole host of different Fed speeches paraded around over the next couple of weeks as well. So we're going to be listening to them and listening in for clues as to what they're going to tell us. I should note that I believe there was 2 members of the Fed believe that we should only have 1 more interest rate hike. There were 9 members that suggested we were going to have 2 more interest rate hikes, which was which seemed to be the most popular place where the Fed was voting. And then there was 3 or 4 members of the Fed that are projecting 3 additional interest rate hikes. But the consensus was that they're going to raise 2 more times. We're going to wait and see about that. So Powell did mention in the press conference that he does not believe that they're far away from their ultimate destination on the Fed funds rate, which is a pretty reasonable thing to expect at this point. We've already raised 525 basis points in the last year and a half, so they've got to be close. Where is it here? They did mention that they're going to continue to significantly decrease their holdings of securities, so that's more QT. The Fed did actually lower their 2023 GDP forecast to 1%, but I believe they raised the 2024 GDP forecast to 1.1% on the whole. So we're going to see what happens from here. I'm not going to make any wild predictions as to what the Fed is going to do next. If the last year and a half has proven anything to a number of economists that have been trying to predict the path of the Fed movements. It's humiliated a lot of economists. We can just kind of leave it at that. So that is a look at the FOMC report from earlier today. We're going to jump onto the charts right now. I got the S&P 500 up here on the chart, and I actually kept the old drawing in here from the video that I did. I believe it was last Wednesday or Thursday. We got a little distortion in here because this is the June. This was the continuation chart was still going off of June as of the 9th. We did get that gap higher because the continuation chart jumped over to September, and there was about a 40 or 50 point premium at that time to September, and that's why you've got that gap in the chart and a little bit of distortion in price. But nevertheless, this prediction right here that we're going to check up and find some stiff resistance off of the 61.8, coupled with this past peak over here at 43.27, that proved to be incorrect because right now the June contract, it's still trading, and that's upwards around 43.70 as of the evening of June 14th. So that was incorrect. I think there was some reasonable, more than enough reasonable reasons to believe that we were going to check up at the 61.8 and this old resistance area, but that didn't be the case. So got some runoff up in here. We got as high as 44.39 yesterday in the S&P 500 September. That's what we're trading right now. But now, again, I'm going to go back to the well on the call that I believe it's reasonable to see some pull down in here in the S&P 500, perhaps back to the 61.8, perhaps a little bit deeper, maybe back to this shelf right here, this support area, which is about 42.65. But to be honest with you, a move back to 4,300 to 42.65, I don't think it's going to get any deeper than that over the near to intermediate term, we should say. I still think this market is projected higher out deep into the summer and the early fall. And then again, I believe we're going to see another period of risk, perhaps a bigger period of risk in September, October, going into the end of the year. So that is a look at the S&P 500. We do have the RSI still registering immediate term overbought up in here. So that's got some room to decline and cool off a little bit. I was getting an immediate term overbought coupled with the RSI just yesterday, which was probably a good indication that when you compare these two indicators up together, that it's a high and rising probability that we're about ready or we're about done over the very, very near term with the upside. So this was a massive squeeze in here. Expect to pull down into 43.15 to potentially as low as 42.65 before we get another resumption of the move back on the upside. So that's a look at the S&P 500. I'm going to look at the 10-year yield here for everyone because there's a lot of questions around the 10-year and what the next move for bond yields is going to be. So clearly the peak over here, 433, that was made, I believe it was in October of last year, saw some decline, bounce lower high, fail, bounced up here to about 408 again, and this made a lower high versus this peak up in here, failed again, chopped around sideways. I actually did believe that we were going to break down further from here, and that didn't happen to be the case. We got this low, or we got this strong low down here, and then we got a higher low, another higher low, and the market has remained positively configured here over the near term. We do have this downtrend line right now that we are currently above. We still might have a little more work to do on the upside. I don't know if we're going to get back into 4%. It's entirely reasonable to believe that we might try to retest this peak up in here, but ultimately I believe that it will fail. So we get a move back up into this area here. We're going to just use a round number 4%. I ultimately do believe that it is going to fail going out into the end of the year for the 10-year yields. And I am looking for another a place to either fade this move by selling 10-year yields or buying the 10-year notes, but I'm not quite there just yet. And rising yields, that is usually accompanied by a rising U.S. dollar. I do think the dollar could have one more battle to the upside in it before that fails, peaks and rolls going out into the end of the year. And we're going to jump over to the gold chart right now, but gold actually looks like it's entering a period of risk right now over the intermediate or over the near to intermediate term in gold. I still remain bullish on gold. We still are holding minimum size long positions in gold. We did go bullish on the gold chart back at the end of last year. It was November, December timeframe. And we're still holding some of those positions out there as well. So my point being here, if rates are going to rise, the dollar is going to follow, and all that is likely a near-term negative for the gold market right now. Let's jump over to the gold. Pulling up the daily chart on the gold market, still very bullish trend in here. We did breach this immediate term uptrend here, and we've just kind of largely been in a range of about 2,000 on the upside to about 1940 on the downside. This evening, we're trading 1947. Maybe we get another wiggle up in here, but ultimately, I do think that we can come down here. This is a 61.8 Fibonacci level down here. I think we can test 1920 to 1915. Potentially as deep as 1875. That'd be the 78.6. We do not want to see it break through this strong swing low down here. If we were to break and take out 1815, you can write this down right now, 1815, then I think the bull market for gold is over. But I don't think that that's going to be the case. We do have a bearish outlook for the U.S. dollar going into the end of the year. I just believe that gold could be in a period where it struggles in here. But I do ultimately think and expect that to be a very good buying opportunity going out into year end. So 3 charts. You know what? Let's do one more right now. It's not all that exciting. It's the crude oil chart. Clearly bearish trend, guilty until proven innocent. I've been saying that a lot. Low end of the range is about 67. I didn't like it when it took out this swing down here on this last capitulation. Not a lot going on in here, to be honest with you. This has been a period. This has been an area, this mid 60 area, where it has found a lot of support, but still not really doing a whole lot with crude oil. I do think ultimately crude will strengthen up going into the back part of the year. But, to be honest with you, going into we're only a few weeks away from July 4th. It's really do or die time right now for crude oil in terms of peak demand. Part of the season here in the United States for that to really start to try to find some footing back in the upside. So not doing a lot with oil. If oil can get back above 70, we'll say 70, 60, I'll take another look at it for potentially this to move across the range to about this immediate term range is about 75. And then, we'll see what it does at 75, potentially get back here up around 80. By the end of the year. There's a lot of calls for that to happen. I'm not so sure. I'm skeptical of that. But if we do get back above 75, I'll entertain the idea that we're going to move all the way across this range here, or the top of the range upwards around 82 in crude oil. So that is a look at a few charts. Quick recap on the Fed. Best of luck to everybody out there. If you have any questions, feel free to reach out to me anytime. Ping me at jcaruso@rgofutures.com. Best of luck. Take care.